Thank you for inviting me to speak today, as this gives me the opportunity to set out my latest thinking in the light of last week's decision by the Bank of England's Monetary Policy Committee. The MPC decided by a majority of 6-3 to leave bank rate unchanged at 4.25%, and I was one of 3 members who preferred to cut bank rate by 25 basis points. I'm tailoring my remarks today to try and fit into the 15-minute slot, but you can read slightly longer remarks and see all the charts online. Now, over the last 8 meetings, a year in MPC terms, we've gradually eased policy restrictiveness in the UK, cutting bank rate 4 times, reflecting the progress made in the disinflation process to bring inflation back towards the 2% target sustainably in the medium term. The persistence of domestic inflationary pressures has been our key focus. Since the start of 2025, we've stressed that we're taking a gradual and careful approach in light of the increasingly uncertain global and domestic environment, which is leading to two-sided risks to the outlook for inflation. Today, I want to set out how my thinking has evolved, building on a speech I gave in South Africa in February. I'm going to focus on the labour market, since notwithstanding all the global events, that's where I judge the most material developments have been in recent months. Although the MPC's focus on uncertainty has increased recently, uncertainty is not a recent phenomenon. Chart 2 shows it's picked up sharply again in the last year, driven in this most recent episode by trade policy uncertainty. Uncertainty is typically thought of as widening the probability distribution of future events, making it harder to forecast what will happen next. More recently, unpredictability has entered the MPC's lexicon to refer to events that are unforecastable based on past experience. And the MPC, like many, has employed the term with regard to the recent shocks to the outlook for the global trading system. Increasing uncertainty and unpredictability is also a key driver for us at the bank for progressing our response to the Bernanke review. Now, notwithstanding the prevailing uncertainty and the unpredictability of events, the main aggregates in the MPC's baseline forecasts for GDP, inflation, unemployment, and spare capacity have actually not changed much so far this year, as shown in Table 1. Underlying growth in GDP is forecast to continue to be weak, in part because of restrictive monetary policy. A hump in inflation is forecast for the remainder of this year. Inflation falls back through 2026 and returns to the 2% target in early 2027. A margin of spare capacity, or slack, opens up and unemployment rises to 5%. Obviously, we will of course publish updated baseline forecasts in August, which will have to take account of the rapidly moving geopolitical developments in the Middle East. Now, given the relative stability in the baseline forecast, what is it about the outlook that has influenced my thinking? The short answer is accumulative evidence of a continued material loosening in the labour market. As a result, while I still think the risks to inflation continue to be two-sided, I'm now attaching more weight to the downside risks in the medium term. Assessing the state of the labour market has been challenging in recent years. And as a consequence, we've increasingly examined the trends in a wide range of labour market indicators. And I want to use the next section of my remarks to set out my latest assessment in 3 parts. First, what we're seeing in terms of labour market quantities. Second, what we can glean from flows data. And third, what's happening on the nominal side of the labour market. The vacancies to unemployment VU ratio has become our primary indicator of conditions in the labour market. As shown here, the VU ratio has come down significantly from its peak in mid-22, with the majority of the move coming from falls in vacancies. We tend to use 2019 as a comparison point for the state of the labour market, given domestic demand and supply was seen to be broadly in balance. And relative to that pre-COVID reference point, the VU ratio is now materially lower. And as vacancies have exhibited an upward trend over time, bank staff have estimated an equilibrium VU ratio, also shown here. And the difference between the observed and equilibrium ratio, the VU gap, gives a measure of the degree of slack in the labour market. In the last couple of years, the VU gap has shown a reasonable correlation with bank staff's estimates of the output gap as shown in chart 4. And on that basis, the VU gap suggests that a degree of economy-wide slack has now opened up. This loosening is also increasingly apparent from the employment numbers. The latest PAYE data for payrolled employees, notwithstanding the potential for revisions, indicates that private sector employee numbers are now clearly in contractionary territory, as shown in chart 5. Growth rates in the public sector are also falling back. Retail and hospitality, the sectors particularly impacted by the national living wage and national insurance contributions increases in April, have fallen particularly sharply. The bank's agents' measure of recruitment difficulties and the REC survey, which has been a pretty reliable indicator of the VU ratio, points to some further loosening in the pipeline, as shown in chart 6. All that said, it's important to stress that what we're seeing in terms of the outlook is a sustained cumulative loosening rather than a more abrupt weakening. The redundancy rate and notifications have picked up only very gradually and remain at a very low rate, though the notification series shown in the left-hand panel of chart 7 does not cover the smallest businesses. A potential leading indicator of a more material increase is the rise in Google searches for redundancy, shown in the right-hand panel. Turning to the LFS-based flows data, I'd like to start by recognising the ONS's efforts in reintroducing these data series, which help inform understanding of labour market dynamics. Although it's important to acknowledge that the relatively slow sample sizes, while rising, mean we shouldn't overinterpret what we take from these data. With that said, I'll just draw out what signal we can take from the inflows to unemployment, the separation rate shown here, and the outflows from unemployment, the job finding rate. Typically, at the start of a more pronounced downturn, there would be an uptick in the separation rate as workers become unemployed. In parallel, outflows from unemployment typically tick down slightly from the start of a downturn. Chart 8, with the job finding rate inverted, suggests initial signs of that process re-emerging over the last year. If the recent trends in flows persist, then we may see signs of a more substantial weakening in the labour market emerging, which would risk unemployment rising more over the next year than in the MPC's baseline forecast. So what are the implications for the nominal side? The private sector regular average weekly earnings data does continue to be volatile, but the April reading of 5.1% was below our recent forecasts, as shown in chart 9. This follows the concerning pickup in AWE growth rates in the second half of last year. Our indicator-based model estimates didn't take too much of a signal from the pickup, but the previous downward trend in wages did level off. Given these uncertainties, the MPC anchored its expectations for earnings to the bank's agents' pay survey, which has had a good track record of predicting actual pay settlements. That survey was consistent with settlements falling from 5.4% in 2024 to 3.7% this year, which would be approaching rates consistent with the MPC's inflation target. The latest intelligence from the agents has continued to suggest average pay settlements for 2025 of 3.5% to 4%. And further encouragement comes from the banks and Brightmind settlements databases, which point to actual settlements since the start of this year in a range of 3% to 4%, although the sample is still partial at this stage. Headline CPI increased to 3.4% in May from 2.6% in March. So we are now seeing the hump in inflation we'd been expecting. The headline CPI number was in line with our short-term forecast for Q2. This shows inflation peaking at 3.7% in September, before easing back to around its current level by the end of the year. The main components of inflation are on different paths, as shown in the chart. I've previously drawn attention to the extent to which we can draw conclusions from these components, noting that the degree of symmetry in the respective rise and fall of each wave gives a gauge on the extent of inflation persistence. The key services ex-rents disinflation process is now clearly slower than in its earlier inflationary phase, and at 4.4% the level is uncomfortably high. It will stay elevated in the short term due in large part to the effects of various administered and one-off price increases. But given the high labour intensity of services, the increasing evidence of a loosening in the labour market should continue to provide a disinflationary impulse. Turning to the other components of the CPI, rents inflation, having stayed stubbornly high, has finally started to fall and relatively steeply. At the same time, what's clearly evident from the chart is the pickup in food price inflation, shown in blue, from the middle of last year. At 4.4% in May, it was above our forecast, and the level of food prices is now 36% above the level 4 years ago in spring 2021. This is significant because there is some evidence that food prices are particularly salient for households' perceptions of and expectations for inflation. Core goods price inflation, shown in purple, has remained subdued, tracking slightly below our short-term forecasts. To complete the picture, even before the latest geopolitical developments, energy price inflation was close to turning positive again in May, after the best part of 2 years in negative territory. When weighing up the risks to the inflation outlook as they've evolved in 2025, I've focused on 2 qualitative scenarios for weak demand and weak supply. To more systematically address the mechanisms underpinning the main risks, bank staff developed 2 quantitative scenarios, which we included in the May MPR. In the staff's weaker demand scenario, uncertainty played a bigger role than in our baseline forecast, weighing particularly on investment, but also on household saving, and leading to domestic inflationary pressures fading more quickly. In the weaker supply scenario, the current hump in headline inflation led to additional second-round effects and more inflation persistence, underpinned by less loosening in the labour market and amplified by weak potential productivity growth. For the purposes of my remarks today, the main evolution in my thinking is to put more weight on the mechanisms at play in the weaker demand scenario, which will be reinforced by the risks of a significant loosening in the labour market. Now, I remain alive to the risk that we will not see the recovery in productivity envisaged in the MPC's baseline forecast. And I'm not ruling out that the wage setting process has become less flexible, for example, through wage setting having become less contestable. Nor am I ruling out that mismatch may have become more pronounced in certain sectors. We'll need to stay vigilant also about the changing composition of inflation and the risk that rises in the most salient parts of the consumer basket, food and energy, increase the chances of second-round effects from the current hump in headline inflation. Similarly, the MPC needs to pay close attention to any evidence that the later stages of the disinflation process, whereby lower wages growth feeds through into lower services price growth, is stalling. These are all plausible considerations, but in my assessment of the risks to meeting our inflation target in the medium term, they've been outweighed by the cumulative evidence across a wide range of indicators of ongoing labour market loosening. In terms of the MPC's June decision, I assess that the signals from the labour market provided a sufficiently strong case for a reduction in bank rate to 4% to guard against the increased risk that in the medium term, inflation would settle at below the 2% target. Given the myriad uncertainties relating to global developments, but also the UK outlook, any policy approach has to be robust to alternative states of the world. Before finalising my vote, I challenged myself on whether sequential cuts in bank rate in May and June would be appropriate if it subsequently became clear that risks to inflation were actually weighted to the upside. It was a finely balanced judgment for me, but I concluded that my approach was robust for 2 main reasons. First, because even at 4%, I assessed that monetary policy would remain clearly in restrictive territory. So if evidence emerged that pointed to higher inflation in the medium term, then bank rate could be held higher for longer than would otherwise be the case. Second, given the environment we're operating in, I think it's important that monetary policy is outlook dependent and should respond and be seen to respond when the evidence on the outlook requires it. I continue to take a watchful and responsive approach to setting policy. I think this is in line with the emphasis the MPC puts in its collective communications on policy not being on a preset path, and that we will consider the degree of restraint which is required from meeting to meeting. I see no inconsistency with my latest vote and the MPC's gradual and careful approach to the withdrawal of restrictiveness. This has served the MPC well over the last year as we've cut bank rate 4 times by a total of 100 basis points in total. And I believe it will continue to serve us well in these times of increased uncertainty and unpredictability, as long as the disinflation process is judged to be continuing in order to return inflation back to the 2% target sustainably in the medium term. Thank you very much.